To that, and we'll talk sustainable investing again, because in light of the circumstances surrounding JS Shark's departure from Rio Tinto, how could investors incorporate, or how should they incorporate ESG factors into shaping investment decisions? Well, Marcus Bogdan from Blackmore Capital joins us live via Skype in Melbourne. Pleasure to have you on, Marcus. Thanks so much for joining us. You know, ESG is something we're talking a lot more about at the moment, and you know, just seeing the departure of JS Sharks from Rio really puts it in firm focus.
It certainly does, and ESG has become incredibly prominent, and just as prominent as the earnings season. And we've seen examples with COVID, with companies taking JobKeeper and issues around paying dividends and bonuses. And we saw it incredibly publicly with Rio Tinto, and more recently with Cleanaway. And so we think this surge and this interest will continue, and it's something from an analytical perspective that we need to really ensure that we embed in our analysis of companies.
So, you know, just in terms of what you see there, would you be switching out of companies perhaps that have maybe strong returns but don't follow those particular ESG metrics? I mean, what do you look at specifically?
Sure. So we look at everything in terms of through the lens of quality yeah. Around earnings, quality around balance sheet, quality around management structure, and then quality around ESG. And so our universe is the ASX 200. And so we want companies in that space, these leading companies in Australia, to be really prominent in those quality factors. And then we overlay that with materiality. And we use things like SASB to look at the core material ESG factors for each industry. And then we make an assessment at a company and at an industry level of how those companies are progressing. So it is one of the lenses that we use, and it's an increasingly important lens that we look at in terms of determining the types of companies we want in the portfolio.
Yeah, because Marcus, it's interesting, isn't it? Even if investors don't care at all about ESG or corporate governance, they're being forced to, because the corporate world is caring about it more and more. We saw it with AMP, we've seen it with QBE, as you said, we've seen it now to an extent with Cleanaway and with Rio Tinto. So whether you want to be interested in it or not, you are forced to as an investor, because we're actually seeing these stocks trade at a discount when these sort of issues arise. Why do you think, it's becoming so important? And I guess, are you seeing certain sectors be more attractive than others?
Sure, and it is absolutely becoming more prominent, and it's affecting valuations. It's affecting valuations in the short term. We saw with Cleanaway an extraordinarily strong result, which was incredibly commendable, but it's given back all of those gains in the last couple of days as the CEO has been investigated by the board. We are not excluding out any industries, and we will make an assessment on materiality of the core issues in each of those companies. But generally, we are overweight industrials and overweight healthcare. But every industry that we look at has core ESG hurdles that it has to attain to and achieve.
We're a couple of weeks out of reporting season now. Any changes in your strategy? We're starting to see the light at the end of the tunnel. I feel like I've said that line a lot, but it really is the case when it comes to a COVID crisis around the globe. A lot of our guests are starting to say, maybe we're open to some of the recovery story now. Do you feel the same way? Are you seeing more opportunity now in perhaps some of the stocks that have been beaten down by the COVID crisis?
Sure, I think it's a really important point around portfolio construction. We're very much taking a barbell approach. I mean, we're still in COVID, we're still seeing companies affected, so we do want to have a very strong stable of core stable companies such as consumer staples, defensive industrial companies. But at the same time, as what you're correctly alluding to, there is a recovery on the way. We're seeing it with greater earnings upgrades by analysts and then downgrades. And so we're at the very early stages of an economic recovery. And so we are turning to those companies that have been deeply affected by COVID. If they measure up in terms of the filters that we use around quality. And one area which has been definitely affected by COVID has been in the healthcare sector. And so that is one area that we're definitely looking at. We saw today that waiting lists for elective surgery in hospitals has increased 20% in New South Wales, over 40% in Victoria. So companies like Ramsay, companies like Helios and CSL all play into that type of recovery. And then we're looking at sort of good industrial companies that can benefit from increased economic activity. In the industrial space, it might be Cube, and for those businesses that will come back online eventually, we're also looking at those areas as well.
Pleasure to have you on. It's really interesting to get your views. So thanks for joining us here on Ausbiz as always.
Thanks very much, Ingrid.